Welcome to Finance Secrets, where we uncover the hidden strategies that the top 1% use to preserve their massive fortunes. Imagine two different worlds. On the left, a high earner loses a third of their hard-earned paycheck to taxes immediately. For the working class, money is taxed before it ever reaches their bank account, reducing their purchasing power instantly and significantly. On the right, a billionaire sees their net worth rise by millions, yet their taxable income remains surprisingly close to zero. Leaked documents from ProPublica revealed a shocking truth. Titans like Jeff Bezos and Elon Musk have paid zero federal income taxes. Despite their wealth growing by billions in a single year, their contribution to the federal tax system was effectively nothing. This introduces the concept of the true tax rate, exposing a massive gap between what workers pay and what owners pay. They utilize a three-step formula known as buy, borrow, die. It is the ultimate code to legally freeze tax obligations forever. This is not tax evasion. It is tax avoidance. It is a strategic game played strictly by the rules of capitalism. To understand this, we must first redefine how we view money, income, and the very nature of wealth in our society. Let us open the vault and dissect the definitions that allow this financial magic trick to happen right before our eyes. First, you must understand realized gains. In the eyes of the taxman, money only exists when a transaction actually occurs. When you sell a stock or a house for a profit, that profit is realized. The IRS knocks on your door immediately. But then there are unrealized gains. This is the paper wealth that grows while you sleep, yet remains untouched by taxes. If your stock portfolio doubles in value but you do not sell, you have technically made $0 in taxable income. This creates a massive gray zone. It is a sanctuary where wealth can accumulate indefinitely without triggering a single tax event. The current tax system is designed around transactions, not wealth. If you never sell, you never trigger the tax alarm. Your salary is a leaky pipe, losing water constantly. Their assets are snowballs, gathering size and momentum without losing a drop. A tax event is the enemy of the wealthy. Their entire strategy revolves around delaying this event for as long as possible. By pressing pause on the tax event, they allow their capital to work at full capacity, compounding year after year unhindered. This is why the richest people in the world do not have high incomes. They have high net worth stored in assets. They often take a $1 salary. They do not want cash. They want assets that grow without immediate tax consequences. The math is simple. Income is taxed at up to 37%. Unrealized growth is taxed at exactly 0%. Society teaches us to chase income, but the system rewards those who chase assets. This is the fundamental flaw of education. Now begins Act 1. Buy. This is not about buying toys. It is about buying the machines that print the money. The ultra-wealthy do not buy just any stock. They avoid assets that pay dividends because dividends are taxable income every year. Instead, they buy growth stocks, companies that reinvest all profits back into themselves, causing the stock price to soar higher. Consider the power of compounding. If you pay taxes annually, you interrupt the compounding curve, destroying potential future wealth significantly. By avoiding dividends and selling, the wealthy allow their snowball to roll uninterrupted for decades, gathering mass at an accelerating rate. Take Warren Buffett. His company, Berkshire Hathaway, does not pay a dividend. He famously almost never sells his stock holdings. His hundreds of billions are largely unrealized gains. The government cannot touch a cent of it until he decides to sell. The strategy is discipline. You must resist the urge to cash out. You must let the asset grow for a lifetime. This applies to real estate, art, and businesses. The goal is total accumulation of value without triggering a taxable event. But this begs the obvious question. If you never sell your assets, how do you buy a house, a yacht, or food? This leads us to Act 2. Borrow. This is the magic trick that turns debt into a source of tax-free income. Why would you sell a stock and pay 20% tax when you can borrow against it at 3% interest? It is simple arbitrage. The cost of borrowing money is significantly cheaper than the cost of paying taxes to the government. This tool is called a Securities-Backed Line of Credit, or SBLOC. It allows you to unlock cash without selling your assets. You pledge your portfolio as collateral. The bank gives you a line of credit. You can spend this cash however you like. Here is the key. Debt is not income. Because you have to pay it back, the IRS does not tax borrowed money. Take Elon Musk, who reportedly used his Tesla shares as collateral to secure billions in loans, effectively using debt to fund massive acquisitions like Twitter without selling his core assets and triggering a tax avalanche. As long as their assets grow faster than the interest rate of the loan, they are actually making money while borrowing it. Inflation also helps them. It erodes the real value of the debt over time, making the loan cheaper to pay back later. But how do they pay it back? They use a technique called rolling over. They simply take out a new, larger loan. Because their assets have increased in value, the bank is happy to lend them more money to pay off the old debt. It is a perpetual cycle. Borrow, spend, wait for growth, borrow more. They live a life of luxury on a mountain of debt. Of course, there is a risk. If the market crashes and asset values plummet, the bank issues the dreaded margin call. This destroyed billionaires like Bill Hwang. If you leverage too much and the market turns, you can lose everything in days. However, the ultra-smart wealthy keep their loan-to-value ratio low. They leave a massive safety margin to survive any market crash. Do not confuse this with credit card debt. Poor people have bad debt with high interest. Rich people have strategic debt. Eventually, the game must end. This brings us to the final and most powerful act. Die. The Great Reset. Death is usually certain, as are taxes. But for the ultra-wealthy, death is actually the ultimate tax avoidance strategy. This is due to a loophole called the step-up in basis. It is the holy grail of intergenerational wealth transfer. To understand it, you must know cost basis. This is simply the original price you paid for an asset years ago. If you bought a stock at $10 and sell it at $1,000, you owe taxes on the $990 profit. But if you die, the tax code allows the cost basis to be stepped up to the current market value. For the heir, the cost basis is no longer $10. It is now $1,000. The past gains are erased. If the heir sells the stock immediately, the taxable gain is zero. Decades of appreciation vanish from the IRS radar completely. It is a complete reset. The tax liability that was building up for a lifetime is wiped clean in a single moment. The heirs can then sell a small portion of the assets tax-free to pay off the loans accumulated during Act 2. The rest of the fortune is theirs to keep, free and clear, ready to start the cycle again for the next generation. Critics point to the estate tax, but with high exemption limits and trust structures, this too is easily minimized by experts. Through these mechanisms, dynasties are built. Wealth is not just preserved, it is compounded across centuries without significant tax friction. Now, let us return to reality. Why can't you do this? Why is this strategy locked away from the 99%? The first lock is the W-2 trap. Most people earn income from labor, not assets, and that labor is taxed immediately before it can compound. The second lock is collateral. Banks lend against appreciating assets, not future paychecks. So without a portfolio or property, cheap leverage is simply unavailable. The third lock is cash flow. When most of your income goes to survival, there is no surplus left to buy the initial assets that start the snowball. That is why the system feels like two different rule books. One for those who work for money, and one for those whose money works for them. Policymakers debate ideas like taxing unrealized gains, but taxing paper wealth raises legal and practical problems, and it becomes politically explosive fast. The cleanest pressure point is the step up in basis. If that reset disappears, the entire die phase becomes weaker and the strategy loses its final escape hatch. That is why the loophole survives. It is not an accident. It is a feature protected by lobbying, complexity, and decades of inertia. But understanding this system is not about anger. It is about awareness. Because awareness lets you start shifting from labor toward ownership. You do not need billions to begin the buy phase. You need consistency, time, and assets that can compound without constant taxable events. Start simple. Buy and hold broad market ETFs or other diversified long-term vehicles, and let compounding do the heavy lifting quietly in the background. Your edge is not a secret loophole. Your edge is time. Every year you avoid panic selling is a year your snowball survives and grows. Now, about borrow. This is where people get seduced because debt feels like a shortcut, but it becomes a trap if your assets are not large enough to absorb volatility. If you ever borrow against investments, keep the leverage conservative. Low loan-to-value is not optional. It is the difference between strategy and liquidation. And if you are not yet in that position, do not force it. The middle-class version of this play is buy, hold, and protect your downside until you are truly ready. Finally, remember the real message. Taxes punish income and reward assets. So the long-term goal is to own more of what grows. Buy, borrow, die is brilliant, legal, and ruthlessly effective, but it also carries risks, and it primarily works best at scale. This is Finance Secrets, decoding the complex world of money. Subscribe now, like, and comment. Is buy, borrow, die fair? Disclaimer. This content is for educational purposes only. Consult a professional before making financial decisions. Thank you for watching. Master the game.